DoorDash held 933 million orders in Q1. The stock ripped after hours, and yet the company is still paying to run DoorDash, Wolt, and Deliveroo like 3 kitchens cooking the same dinner.
That's almost too accurate.
Today is May 6, 2026. For posterity, you're listening to Earnings Unscripted, and we're looking at DoorDash, ticker DASH, Q1 2026. Fast baseline revenue came in at $4.03 billion, up a bit from last quarter. EPS was 42 cents, and the market clearly liked the print.
Yeah, the market liked the direction, not every line item. The stock had been beaten up during the quarter, down about 36%. Then after the release, it jumped roughly 12% in extended trading. That's a pretty dramatic mood swing.
Very DoorDash. 1 minute your fries are cold, next minute investors are tipping 20%.
Exactly. But look, the business is still growing. Marketplace GOV hit $31.6 billion. Total orders moved higher. Revenue was up 33% year over year. That's not fake demand. People are still tapping the app for dinner, groceries, convenience, increasingly all of local commerce.
And quick legal vegetable before we go further. None of this is financial advice, just our personal opinions and mild earnings-induced caffeine damage.
Good. Necessary vegetable. The tension is profitability. GAAP net income fell to $184 million from $213 last quarter. Adjusted EBITDA dipped to $754 million, and net revenue margin slipped to 12.8% from 13.3%.
So growth up, margin down. That's the little eyebrow raise.
Right. Although free cash flow was actually strong this time, $420 million, up a lot sequentially. So it's not a cash panic story. It's more like, okay, where is the operating leverage hiding and how much of it is being eaten by integration, gas, weather, and all of the other very physical problems of delivering sandwiches in the real world?
The weather thing was oddly grounding. Extreme winter storms clipped GOV growth by about 1%. And they spent around $50 million on Dasher gas relief. For all the AI talk, this business still runs on roads, cars, and people trying not to slide through intersections.
It's the part I like, honestly. It's a tech company until gasoline moves against you. Then suddenly it's a logistics company with an app.
Beautifully bleak. And we should say we do not have the clean streak consensus sheet in this research pack, so we're not going to fake a beat or miss ceremony here.
Yes. The honest read is investors saw durable demand, better cash flow, and Deliveroo momentum. But they also have to swallow a year of redundant costs because management said they're running 3 tech stacks in parallel while moving toward one global platform.
Which sounds expensive in the way we're renovating the house while hosting Thanksgiving sounds expensive.
And there's another twist. Tony Xu said nearly 2/3 of DoorDash's code is now written by AI. So you have the strange duality. AI may be accelerating engineering output, but the company is still dragging 3 platforms into one architecture. Productivity gains versus inherited complexity.
Plus the avocado mission.
Yes, the avocado mission.
I loved that. Their grocery moat is not just chatbot find me dinner. It's knowing where every banana sits, whether an avocado is ripe or unripe, and turning the physical store into structured data.
Which is a much better AI story than most companies tell. Less magic text box, more inventory truth. But we'll need to see if that truth converts into margin, because right now the headline is scale is real, integration cost is real, and the market just decided the scale matters more.
All right, let's get into the details, because this quarter is really about what DoorDash is willing to pay now for leverage later.
Yeah, and the important part is this isn't one bill. It's a stack of bills. Integration, gas, weather, restructuring, and then the ambition tax of trying to turn local commerce into one global operating system.
Ambition tax. That's very polite. I was going to call it everything expensive happening at once.
Also accurate.
But the tech stack piece is the most revealing to me. Ravi said there is, quote, a portion of the spend which is redundant in the sense that we are going to run all 3 tech stacks in parallel while we're working on the global new tech stack. That sentence is doing a lot of work.
Because redundant spend is usually the phrase investors hear right before they start clutching the model.
Exactly. But look, I'm not automatically negative on it. If DoorDash bought Wolt and Deliveroo and just said, great, everyone migrate to headquarters software by Friday, that would be stupid. These are live marketplaces, careers, merchants, consumers, payments, subscriptions, local compliance. You break one pipe, dinner doesn't arrive.
And nobody says, yes, classic enterprise migration issue when their sushi is 40 minutes late.
Right. They blame the app and delete it. So DoorDash is basically accepting near-term inefficiency to avoid service degradation. That's rational. The question is whether they can actually retire those old systems on schedule, because management is telling you this cost bleeds through 2026.
So the market is celebrating scale, but the operating leverage is sort of not delayed exactly, but trapped behind construction cones.
That's the cleaner way to say it. And Deliveroo makes this more interesting because Tony said Deliveroo is seeing the highest growth rates it has in the past 4 years, and that it has been re-accelerating month by month since DoorDash has operated it. If that keeps happening, investors tolerate the duplicate tech bill.
Because the acquired asset is waking up.
Yes.
If it stalls, then suddenly the same spend gets reclassified emotionally from investment to why are we paying for this?
And there was also that restructuring charge, right? The one that didn't exactly get a marching band in the press release.
Yeah, $48 million in Q1 versus 0 in Q4. Not catastrophic, but it matters. Without it, the sequential profit story looks cleaner. And I don't want to overstate that because stock-based comp came down and share count was basically flat. So it's not low quality across the board. It's just the P&L has a few rocks in the shoe.
The other rock is gasoline, which feels almost comically old world for a company talking about AI written code.
It's the whole DoorDash paradox. They can have AI writing nearly 2/3 of code, according to Tony, and still get hit by pump prices. The Dasher gas relief program cost about $50 million gross in Q1, and Q2 assumes more than $50 million again.
And they're not just absorbing it casually. Ravi said they had to push out some investments in H1 to make room for it. With conviction, they'll make those investments in the second half.
Exactly. That's the sentence I'd underline. It tells you EBITDA is not just magically resilient. It is being managed. They are moving furniture around the house so the room looks clean when guests arrive.
That is vivid and a little accusatory.
It's not an accusation. It's budget management. But it means investors should not treat first-half margins as purely organic leverage. Some spend has been deferred. If gas remains painful, or if integration costs run longer, or if European labor rules become more expensive, the offsets get harder.
On Europe, we should be careful, but the risk is real. The 10K flagged the EU platform work directive pressure and Finland's ruling around Wolt couriers being classified as employees. That's not a footnote if your growth story is increasingly international.
No, it's not. And this is why I keep coming back to physical complexity. DoorDash is not just running software. It is coordinating human labor, kitchens, cars, stores, weather, regulators, and now multiple inherited platforms. The app is the pretty surface. The machine underneath is very industrial.
That's also why the grocery and catering stories landed for me. Tony's point on catering was basically, it sounds simple until you realize most restaurants are not built like manufacturing facilities. Bigger orders create kitchen constraints, menu constraints, staffing constraints, vehicle constraints.
Yes, and that is the moat if they solve it, not the button. Everyone can build a button. The value is knowing whether the merchant can actually produce the thing, whether the courier can move it, whether the inventory is real, and whether the economics survive the trip.
So this quarter is less DoorDash had a clean profitability step up, and more DoorDash is buying complexity now, hoping it becomes leverage later.
That's it. Demand is real. Cash flow is strong, but the next phase depends on execution discipline, not just order growth. The question now is how patient should investors be while that complexity gets converted into actual margin?
I think patience is deserved, but not unconditional. Like, DoorDash has earned some benefit of the doubt on demand, but investors shouldn't confuse big machine getting bigger with machine getting easier to run.
Exactly. The next quarter guide is useful here. They're pointing to Q2 marketplace GOV between 32.4 and 33.4 billion and adjusted EBITDA between 770 and 870 million. So still growing, still profitable on that adjusted basis, even with another more than $50 million gas relief cost baked in.
Which is actually pretty impressive, but also a little revealing. Because Ravi said, quote, if we do decide to extend the gas rewards program, we'll find offsets in other parts of the business. That sounds disciplined, but it also means something else gets squeezed.
Yeah, offsets are never free. They're delayed hiring, postponed projects, slower experiments, maybe less marketing. So the thing to watch is not just EBITDA. It's whether growth quality holds while they keep moving spend around.
And whether Deliveroo keeps doing the thing Tony said it's doing, right? Re-accelerating. Because if that keeps going, the integration pain looks strategic. If it fades, investors start asking why they're funding 3 kitchens, 3 menus, and 1 very stressed head chef.
Good. Slightly cruel, but good. I'd also watch Europe. Labor classification pressure is not theoretical anymore, especially with Wolt-related rulings in Finland. If the model gets more employee-like in key markets, that changes the margin story.
So the clean version is DoorDash is still a very impressive growth company, but the next phase is less about proving people want delivery and more about proving the platform can absorb complexity without losing economics.
Demand is no longer the exam. Execution is.
That's a good place to land. DoorDash delivered the growth. Now we watch whether it can deliver the leverage. Thanks for listening, everyone.
See you next time.
If you'd like these earnings chats to just show up when a new one lands, following the show is probably the easiest little habit. And quick transparency note, Earnings Unscripted is made with AI assistance, with each episode grounded in company filings and earnings called transcripts rather than scraped vibes. If you've got feedback or a ticker you want us to tackle, send it to earningsunscripted@datamadness.ca or use the X link in the show notes. Thanks for listening, and we'll see you next time.
Take care.